Hey everybody, welcome to Smart Money, or I should say Verified Investing's game plan. My name is Gareth Soloway, Chief Market Strategist here at verifiedinvesting.com. So, number one, as always, no BS, just charts, which means probabilities. And my goal here in these game plans is to always teach and educate while giving actionable setups in the market for the day. All right. So, what do we have? Over the weekend, we saw generally a quiet market action period, not a lot of major news. The one thing that did come out over the weekend was that NVIDIA and AMD will be paying 15% of their revenue to the US government, kind of a pay to play type scenario. In order to sell to China, the US will reap the rewards of 15% of those revenue streams. Okay, now let's get right into the charts today. As we get into this, let's take a look at the S&P 500. First and foremost, what we're seeing here is the markets are up slightly. Now, no surprise here, right? We've been in generally a bullish period in the markets. This is where the market closed on Friday. So you can see again, Friday we closed here. After hours on Friday, we went up, we came back in, we kind of floated. And then in the overnight, when the markets opened on Sunday night, we've been chopping around with a slight positive bias. Now you can see we are fading just a little bit. And we are seeing, by the way, technology is slightly lagging the S&P. And in other words, the NASDAQ lagging the S&P. And that is only, again, because of names like NVIDIA. NVIDIA, again, is lower on the day with AMD because of that news. Now, listen, overall, it's only down about $1, which makes sense because remember, it's only on the revenues from China. So remember, they weren't allowed to sell those H20 chips to China prior. Now they're allowed. It's just subtraction of 15% of those revenues, which again is not the end of the world for NVIDIA, but another way that the US government is creating a stream of income or revenue generation. All right, so let's go back to the S&P, flipping over to the daily chart. Let's take a look at where we sit here. So what we see here, folks, is a chart that I've shown you all of last week. It's a parallel from the lows here of October to the low here from April. And if you take that and connect those 2 points, you get a trend line, which then becomes a perfect parallel to the high here in December, all the way up to the high that we just hit. And we can see again right here, the high on the gap up a few Thursdays ago on Meta and Microsoft's earnings when there was jubilation out there. And we had Meta up over 10% and Microsoft initially opening up nearly 8 to 9%. Then the big fade came in, and that's exactly where we still put in the highs. Now, what's so fascinating to me is that you've gotten a bear flag off of that. And remember, again, this is technically, if you looked in a textbook, this would be what you would find in what would be called an in spirit of bear flag. Bear flags, remember, are right angles. In spirit of is up to a 45-degree angle. If it gets past 45, the odds are not favorable to downside, but this is still within that range where it would be looked at as an in spirit of bear flag. All right, now how do you negate a bear flag? Simply just close above the flagpole high. So again, basically 64.30, you would negate the bear flag. You would still have the yellow trend line of the parallel at around 64.40, but you would no longer be able to say, okay, this is a bearish formation on the chart. Now, what I found interesting here, guys, is that even though the S&P has not taken out the high of the bear flag, I've noticed that sentiment among many retail investors is even more bullish than it was when we were at the previous high. Now, if you looked at an RSI chart, this would be something that we would refer to as a negative divergence, meaning that sentiment is getting more bullish, but the S&P is not making a new high. To me, again, it's somewhat unscientific, but it is an indicator that the markets are seeing institutional dumping, as I've said before. But ultimately, again, retail continues to buy into the market and put more leverage on the table while these institutions are slowly basically loading or unloading positions into retail. And again, that's always something that historically, and I've been trading since 1999. So I saw the dot-com collapse. I saw the 2007 highs before the Great Recession, and obviously through COVID. It's something that's very, very similar. These type of things show up over and over and over again. All right, so that's your chart there on the S&P. Let's monitor. One other thing for those of you that know the methodology that I teach, we are very close to a time count here, which is basically when you get to a time count, the odds are the highest of a sell-off. If it gets past the time count, then it reverts back to kind of just favoring the downside. But once you come into a time count here, and remember, time factors are really the most important. Price, pattern, and time are the three things I focus on in trading and technical analysis: price, pattern, and time. All right. Time is actually the most important, the time factor. But again, you obviously want the other factors there as well. All right. Last thing I will tell you guys is, and this is very intriguing data, is that the NASDAQ, or the tech sector, has now bubbled up to where it is a bigger value relative to the S&P than even in 1999 and 2000. All right. So again, if you look at the weighting of technology, it is now higher than it was in 2000 during the dot-com bubble, just before it collapsed. Now, by no means does that mean, hey, we're on the verge of a collapse like the dot-com, but it just is one more warning sign that as an investor, I pay attention to. Right? I want to know these things. I want to be aware. Even if I trade differently, that's fine. At least I can't look back and say, oh, my head was in the sand. I didn't have any idea. At least I'm making an informed decision, which is what we all want to do here as technical traders. All right. The US dollar today is up fractionally. Not much of a move here, guys. Again, just up slightly. I wouldn't say there's really anything new to divulge on this. Beautiful parallel channel that the dollar is still stuck in. And again, we're not at the highs, in which case it would be a sell, and we're not at the lows, in which case it would be a buy. Ultimately, we are still in a downtrend. The 10-year yield down slightly. This would be another example of a kind of a little bit of a stretch on a bearish pattern, but the fact that it's coming after breaking down through this wedge pattern low and ultimately confirming the breakdown here on this candle, this again would be overall slightly favoring the downside. In fact, decently favoring the downside. So you have a wide range reversal or breakdown candle, and then inside bar action here. That's inside of this move, which is basically digestion of that breakdown. We're below this trend line, and we've confirmed below. So that would, again, give us a negative bias on the 10-year yield for eventual break to the downside. Now, we are down today, but we don't know yet if it's going to be the beginning of the bigger move or if it's going to just chop a little bit more. We talked about NVIDIA here, NVIDIA down on the day. The only thing on NVIDIA that I care about, though, is this trend line. This trend line in technical analysis, this would be essentially your break point. And my gut is telling me that when this breaks, that's when the markets start to break. And listen, maybe NVIDIA continues to hold this line for the next week, 2 weeks, 3 weeks. We don't know. But one thing I do know is that NVIDIA has led the market up, and it hasn't broken this trend line, even though the S&P has broken this upsloping trend line, right? We've looked at that before from the very lows of September 7th. And ultimately, if this breaks, that would be your break point for where you would expect, okay, this led the markets up. Likely the markets would be led down by NVIDIA. AMD is a little bit different here, guys. As we take a look, you have this nice little uptrend as well. This stock, again, has gotten a little bit ahead of its skis, but it has slowly started to correct. One thing here, though, this trend line would remain support. So you can see from your April 7th low through the low here on the 21st of April, all the way to your low here on June 13th. It could actually pull back to this level, and this would still be major support. And so that's something else. There's one other trend line, though. You can see right here. There's this trend line as well. This would be a secondary trend line. So essentially, if AMD breaks 166, you would expect a fall to about 150. But at that point, it would get a bounce, or you'd anticipate a bounce. And so there might even be a trade there, right? Technically speaking, if it breaks 166, you could short it and then cover your short and go long at 150 for a technical bounce there. All right, big move here, guys. Take a look at the drop on C3AI. This is remarkable because this is an AI play. And they basically pre-announced their earnings today, guys. They pre-announced, they're not supposed to report until early September, but they pre-announced and their numbers are not good. Their estimate for revenue was about 104 million. They're telling Wall Street they're only going to come in around 70 million in revenue. That's a 33% lower amount of revenue than was expected. All right, that is not good. And that's why the stock is down like 34, 35% today on the day. In addition, year over year, a 19% growth drop, meaning that they actually slowed. They're making less by 19% than they did last year. Now, who knows what's going on internally with this company and whether or not it speaks to the larger AI scenario. But the one thing we do know is that when you miss in this market, you get pounded. The stock gets crushed. We saw that with TTD last week. What a big drop on that one. Again, here on AI, C3AI, symbol AI, we're seeing it again. All right, so where's the buyable level? I already have my levels isolated down to trade today, and you can see it on the intraday, but let's flip it over to the daily chart. And this is my level today, basically a pierce of $14. There's a key level of support. It even looks better on the weekly chart here. You can see on the weekly little area right here. In fact, you could even extend this out right over to this low right over here as well. So basically from 1395 down to about 1325, there will be a good amount of technical support on C3AI. If this were to flush during market hours, I'd be looking to buy that as a day trade today, not a swing trade though. All right, this company had bad news. I want to stay away as a swing trade, but as a day trade, 1395 to 1325 is a good buyable level. Monday.com is also getting trounced here, guys. If we take a look at the intraday chart, look at this, guys. What a drop on Monday. Closed on Friday at around 250 or just below 250. It is now trading below 200. That is a massive $50 drop on this stock in the pre-market. Guys, we're seeing more and more of these. I mean, listen, this goes back to what I just said, is it's the haves and the have-nots in this market. All right, the haves are, Microsoft, Meta, NVDA, and that group, again, the big cap tech, the technology area, that now makes up, again, something like 55% of essentially of the whole market, their market caps, which is massive. Like I said earlier on, that's bigger than during the dot-com bubble when you had all these crappy dot-coms and some good ones that were massively overweighting. And we know what happened to the dot-coms. Now, listen, I'm not saying, again, there's going to be a bubble bursting here at any point in the near term, but I would just give that as a kind of a heads up to you guys out there that want real information, not the narratives. Listen, you want the narratives about how great the market is. CNBC, Bloomberg, they're all there for you guys. Heck, you could go to social media and get the fill of all the greatness about how this market is going to go up forever. I'm a realist. I've been through collapses. I've been through bubbles bursting. And I'm just drawing the parallels to past scenarios. Not to say that future scenarios repeat perfectly, but they tend to rhyme. We always have to remember that, guys. All right. So back to the chart on Monday. Monday again now moving even lower here in the pre-market. I do have my levels here on Monday. Notice the major pivot low here and the gap fill here that creates a zone of support at 188 to 182. So we're only about really less than $10 away on Monday from the first level of support, where this will become intriguing as a buyable potential good setup intraday. All right, let's go on to gold. Gold is getting punished today. Great drop on gold. Look at the chart though. All right, did we talk about this or did we talk about this last week? We had the breakdown here, right? Confirming the breakdown right here. So this became a legitimate confirmed breakdown. We came down a little bit more. Then we retraced and noticed how it hugged the underbelly. And I kept on saying to you guys, even with gold pushing up on like Friday and Thursday here, I said, guys, as long as it doesn't test and break above and confirm above this zone, You have to be on the bearish side. And again, it's not my feelings, right? And I want to explain this. It's not my gut. It's not my personal belief. In fact, I'm a huge bull on gold mid to long term. But the charts are what are in charge. Always remember that. It's not Charles in charge. It's charts are in charge. And if they are telling me that there's resistance and prices into resistance, it's not up to me to say, oh, well, this time will be different and it will break through. At some point, it probably will. But I have to go with the fact that it has been resistance. It's a confirmed breakdown, and therefore I must respect it until it proves me otherwise. And that's the key. That's a good technician. And I've learned this the hard way by, in early in my trading career, I'd be like, oh, well, this time it'll break out and I'll go long, right? And then it's like, boom, oh, dang, I shouldn't have done that. I'm down on my trade. Maybe eventually it turns into a winner. But the point being is that the charts are in charge. And here's a good example of that, beautiful example of that, how price kept on hammering on the underbelly here. I heard more and more bullishness in the near term, and then boom, today. And again, doesn't mean tomorrow we can't go back up and maybe break above it. But right now, the bias remains negative. Now, take a look at GDX. GDX told us on a chart basis that gold was likely going to turn down. Why? Well, take a look at this trend line. Look at this. This trend line goes back to October of 2023 when it was support and it was climbing this wall. Then it broke down below that in 2024, and it now became resistance. And look at how every time you hit this trend line, right, you basically get a pullback. And so where were we on Friday? We were right up into that line. And you could basically say, okay, from a technical perspective, if the GDX, the gold miners, are saying they're at resistance and going to pull back, does it make sense that gold would go higher? Or would it be more likely that gold would pull back, which would then cause miners to pull back? And the answer is, yeah. I mean, it would make sense that gold would pull back. And look at the miners today, all the way down at 56.50, already pulling back. Now, on a base case here, we have support around $53 on the GDX. So if we come down another $3.60, we'll then tag support. All right, Bitcoin. Wow, Bitcoin over the weekend surging up. Again, I'm always a little suspect on weekend moves because the volume is a little bit thinner. But look at this big move. So we knew we had resistance here. It came up, it rejected it, and then it pushed through. And then look at this. Overnight on Sunday, we pushed up, and then look, they've already reversed it. And the one thing that you have to remember is that the bear candle, meaning the topping tail right here, that remains the level. And I went over this quite a bit on the weekly wrap up on Friday afternoon, the game plans last week. And what I said to you guys was, listen, you can believe whatever you want to believe, but the charts are in charge. Okay. Which means that until you negate the topping tail, which is here. All right. And the way you negate the topping tail, you need a daily close above the topping tail high. Then technically you must be suspect about whether or not this is the next bull run, or is it just a retrace when the stock market is at all-time highs with buyers coming in. Now, listen, we'll see where this ends, but pretty nasty little reversal here early in the day. But again, if we get a daily close above 123,200 or so, okay, now game on. Like I said last week, you can go to 130, maybe 135, maybe 140. But as long as you do not have a daily close above this, you must be suspect about it. And that's just probabilities, guys. It's nothing to do with personal feelings, nothing like that. It doesn't really matter, frankly. It doesn't matter what I think, what you think, what anyone thinks, frankly. It is all about the probabilities. And the faster we all learn that, the better we all trade, right? I mean, that's really what it comes down to. All right, let's go to ETH here. I'll do ETH real quick. Ethereum, look at this, guys. It is pulling back a little bit. All right, so again, we went up right here. Look at this parallel that I found that stretches all the way back from the lows in June of 2022 to the high here in April of 2022. And you can see, again, it connects beautifully right through here and right through these highs. And so what this tells me is ETH is now short-term into some resistance. It always could break, but right now it's short-term extended, right? We've gone from this low just basically a week ago of 3,300 to 4,300. So you've had a massive percentage move up. It now needs a little break, and the parallel is giving it that example. Now, in terms of support, if this does pull back, where would support be? It would be at the former pivot level right there, right? So you see here, if it pulls back, this $3,870 level would be your first technical support, where you would watch to see, okay, then does it take its next leg up? If it breaks that, then you have 3360 here as your next level. But right now, this is your support and this is your resistance on the chart in the near term. All right, next up, let's take a look at oil today and see where oil's going. I didn't look at silver. I'll look at silver real quick, though, no problem. But again, oil is getting a small bounce. 1, 2, 3, 4, 5, 6, 7. I said this on the weekly wrap up on Friday. This is a time count, and time counts tend to have short-term reversals. So again, not surprising to see this. Resistance will remain at $65 a share because that is a confirmed resistance point. Silver, let's look at silver real quick here. Silver getting a little bit of a pullback. You had the down move off this longer term trend line, very similar to what we saw in the GDX, right? This upsloping, ascending trend line hitting and then getting rejected. And here you had a retrace and now coming back in. But that ascending trend line, very similar to what we looked at on the GDX, this ascending trend line as well. All right. And then lastly, natural gas. Let's go to nat gas here and see where that is on the charts. And natural gas, again, it just continues to flutter around support. Open below, now back above. It continues to chop around the technical level right here. Again, if it breaks and confirms, you're looking at support at around the 263 level. All right, guys. So listen, again, as always, it's all about the charts. Like I say, no BS, just charts. Again, the hype, save it for mainstream media and social media. Here at Verified Investing, I want to give basically the odds. Think about me as an odds maker or as just a player that's telling you which team is likely going to win. Doesn't mean they're going to win, but it's what is favored. The good thing about technical analysis, I found that if you do it right, you can get your win rate to about 75% or greater, just slightly greater. Very hard to get to 90, 95%. I mean, that's almost unheard of. In fact, might be even unheard of. But can you win 3 out of 4 times? I do believe so if you follow the charts. All right, guys, I got to get going here. As always, thank you so much for tuning in. I'm going to be in the live day trading room, day trading this market. We'll be day trading AI and Mondaycom, all these plays that are getting hammered today. We'll be looking for trading opportunities there. Thanks again for tuning in. Much appreciated. Have a good one.